Welcome back to the Deep Dive from TalkTickers. We're here to cut through the noise and get you the real insights from the latest earnings calls.
And today we're digging into Navitas Semiconductor. Their Q2 2025 results came out after the bell on August 4th.
Right, and they definitely caused a bit of a stir in after-hours trading.
Yeah, but the really interesting part here isn't just the quarter's numbers, it's this, pretty significant strategic pivot Navitas is making.
A pivot. Okay, intriguing.
They're basically reshaping their whole future focus. It's a reaction to, some huge industry trends, especially around AI and electrification. It's fascinating.
Okay, definitely want to get into that. But let's start with the basics, the Q2 numbers themselves. What did they report on the bottom line?
So the GAAP EPS, that was negative 25 cents, which missed the consensus estimate of negative 0.05 cents.
Ouch, missed by 0.20 cents. That's substantial.
It is. But interestingly, their non-GAAP EPS was actually right in line with what analysts expected at negative $0.05.
Okay, so a divergence there between GAAP and non-GAAP. What about revenue?
Revenue came in at $14.49 million. That actually nudged slightly above the consensus of $14.36 million.
So a slight beat on revenue.
Yeah, but, and this is important context, that's still down 29% compared to Q2 last year. They did $20.47 million back then.
Right, okay, so year-over-year softening, but non-GAAP EPS in line and a slight revenue beat for the quarter.
Yeah.
How did margins look?
That's where it gets a bit more positive. The non-GAAP gross margin was pretty solid at 38.5%.
Okay.
Which looks especially good compared to the GAAP gross margin that was negative 11.8%. Big difference there.
Huge difference. And operating loss.
The non-GAAP operating loss landed at $10.6 million, and that's actually a 21% improvement year over year.
So they're controlling costs better even with lower revenue.
Exactly. Shows some good discipline there.
What about their cash position? You mentioned this pivot. Are they funded for it?
They look pretty well set up, actually. Cash on the balance sheet is strong, $161.2 million.
Okay.
And that got a big boost from a $97 million equity raise they did during the quarter. Gives them a lot of runway.
Good to know. And inventories.
Inventories are down, too, to $15.1 million. Another sign they're tightening things up operationally.
So bringing it back to the market reaction, despite that big GAAP EPS miss, you said there was some interesting action.
Yeah, that's right. Shares actually ticked up modestly, 1.1% in after hours.
Okay.
But the volume was really high, about 4.5 times the normal 90-day average.
Wow.
And specifically, those August 9.5 call options, they traded like 6 times their usual volume.
So what's the takeaway from that? Investors just ignored the GAAP miss.
It really seems like it. It suggests the market, or at least a significant chunk of it, looks straight past that gap figure. They seem focused on the operational improvements, the cost control, and I think, crucially, this future potential we're about to discuss.
Right, they're betting on the transformation story.
Pretty much. It feels like they're saying, okay, current numbers are what they are, but we see where you're heading.
Which brings us perfectly to that pivot. Lay it out for us. What exactly are they changing?
Okay, so management was super clear on the call. They are actively, intentionally shifting focus away from their traditional bread and butter. Mobile chargers, consumer electronics, that kind of thing.
Moving away from mobile, where are they going instead?
Straight towards the really high growth areas. We're talking AI data centers and EV drivetrains. It's not just tweaking things, it's a major reorientation of the whole company.
That is a big shift. Any specific examples?
Yes, and a big one. They highlighted a joint project they're doing with NVIDIA. It's an 800-volt gallium nitride or GaN-N-based high-voltage DC system.
With NVIDIA. Okay, that's the name that gets attention.
Definitely. And they put a number on the opportunity just in this space. A total addressable market, a TAM of $2.6 billion by 2030, just for AI data centers and energy infrastructure around them.
$2.6 billion TAM. Wow. And what's driving this demand?
It's the absolutely explosive growth in AI processing power. I mean, the amount of energy these things consume is just skyrocketing.
How much are we talking?
Well, get this. AI processor power consumption is projected to jump from around 7 gigawatts in 2023 to over 70 gigawatts by 2030.
70? That's a tenfold increase.
Exactly. In just 7 years. It creates this enormous power problem for data centers. And, where there's a problem like that,
there's a massive opportunity for efficient solutions.
Precisely. And that's the gap Navitas is aiming to fill with their GaN and Silicon Carbide, or SiPSiC tech.
Okay, so how are they breaking down this opportunity? You mentioned 800-volt systems.
Right. They detailed 3 key power conversion stages needed for these next-gen 800-volt data centers. And crucially, they claim they have solutions for all 3.
All right, stage 1?
Stage 1 is getting power from the grid down to that 800 volts. This often involves something called solid-state transformers, or SSTs.
Grid to 800 V, what kind of tech does that need?
This needs ultra-high voltage UHV Silicon Carbide CR to handle that grid interface. Navitas is pointing to their Gen C tech, which can handle up to 6.5 kilovolts.
6.5 kV. That's serious voltage.
Oh, yeah. They reckon this stage alone is like a $500 million a year market just for grid-powered data centers, maybe over $1 billion total market by 2030. They expect mass production for this ramping up in 2027.
Okay, stage 1 is CLRO, handling the big voltage drop. What's stage 2?
Stage 2 is taking that 800 volts down to 48 volts. This happens closer to the servers, often with DC to DC converters right on the motherboards.
So space and efficiency become critical there.
Absolutely critical. High frequency, high efficiency, high density. They say it's a perfect fit for their new mid-voltage GaN technology, and they're targeting another $1 billion TAM there.
$1 billion for 800V to 48V using GaN.
Yeah.
And the final stage, closest to the processor.
That's stage 3, yeah. Dropping from 48 volts down to 12 volts, maybe even lower, right next to the AI chip itself. This is arguably the most critical stage.
And what's the tech for that?
Here, they'll use their new 80 to 200 volt GaN. The key thing they highlighted is industry-leading performance, frequency, efficiency, density, all packed into a tiny 5 by 6 millimeter package.
5 by 6 millimeters. That's incredibly small.
Right. Think about the real estate on a packed server board. That tiny size is a huge advantage. And this, they say, is the largest piece of the puzzle, a $1.2 billion per year TAM.
So across these 3 stages, you've got UHV SiC, then mid-voltage GaN, then low-voltage GaN.
Exactly. And Navitas made a point of saying they believe they're one of only 2 suppliers out there who can actually offer that full range of technologies needed for these advanced 800-volt systems.
That sounds like a significant competitive moat, if true.
Potentially, yes, assuming they can execute. Which brings us to manufacturing.
Right. Having the tech is one thing, making it at scale is another. What's the plan there?
This was another huge piece of news on the call. They announced their first volume deal for 200 millimeter GaN wafers, and it's with Powerchip.
Powerchip. And 200 millimeter, that's what, 8-inch wafers?
Yeah.
Up from 6-inch?
Exactly. Moving from 6-inch, which they use with TSMC now, to 8-inch with Powerchip. It sounds technical, but the impact is massive.
How massive? What does that really mean for them?
It effectively doubles their wafer capacity, just based on the surface area increase.
Okay.
More importantly, it means significantly more chips per wafer, which drastically cuts the cost per die.
Ah, so it gives them scale and better cost structure. Crucial for competing in these big markets.
Absolutely crucial. They need that scale and cost reduction to really go after the AI and EV volumes.
What's the timeline for this Powerchip ramp?
Initial samples of the mid-voltage GaN from Powerchip are expected next quarter, Q4. Production ramps early 2026. The high-voltage GaN samples start late this year or early next, with production ramping later in 2026.
Okay, so production really starts hitting in 2026. What about their current supply from TSMC?
They make sure to address that. They said TSMC is committed to supplying them through mid-2027. So that should bridge the gap and ease any customer concerns during the transition period.
Smart. Okay, so they're beefing up manufacturing for the new focus areas. What does this mean for the old focus, the mobile business? Are they just dropping it?
Not dropping it entirely, but definitely deprioritizing. They were explicit about reducing focus and R&D investment in the more, let's say, mainstream, price-sensitive mobile, consumer, and appliance segments.
Especially in China.
Yes, particularly in China, citing the ongoing tariff risks as a major factor there.
So what will they still do in mobile?
They'll sharpen their focus on the really high-end performance stuff. Like, they just launched a 90-watt GaN charger with Xiaomi that's the size of a credit card.
Ah, so showcase projects that demo their tech leadership.
Exactly. Maintain a presence, show off the tech, but shift the core R&D dollars over to AI and energy infrastructure. They acknowledge this pruning will likely hold back revenue in the near term.
Makes sense. A necessary evil for the bigger price.
That seems to be the calculation, yes. It's essential to free up resources for the big pivot.
Okay, let's circle back to the financials then. Given this transition, how's the discipline holding up?
Margins. Spending. Well, like you said, that non-GAAP gross margin bounced back to 38.5%, even with lower revenue. They credited tighter inventory management and also getting rid of some older, low-yielding C production lines.
And operating expenses. OpEx.
Also down nicely. Sequentially, it dropped to $16.1 million from $17.2 million, and year over year, it's down 25%. That really shows strong cost control while they retool.
Good discipline.
So,
Now, they mentioned taking a hit on inventory related to tariffs.
yeah, a $3 million inventory reserve specifically on U.S.-produced Seacory products. It's because of the impact of China tariffs, making those less competitive there in the short term.
How are they spinning that?
They actually framed it as a potential long-term positive.
Really?
Because those products are U.S. produced. They think that will ultimately be a strategic advantage with U.S. customers who are increasingly looking for domestic or non-China supply chains. So short-term pain, potential long-term gain.
Interesting angle. Okay, looking ahead, what did they guide for Q3?
For the next quarter, Q3, they're guiding revenue to $10.0 million, plus or minus $500,000.
10 million. So down sequentially again, reflecting that mobile shift in tariffs.
Correct. That's the expected impact. Non-GAAP gross margin is forecast to stay pretty flat, around 38.5% plus or minus 50 basis points. And non-GAAP OPEX should be around $15.5 million, so continuing that tight control.
And cash burn.
They expect to use about $10 to $11 million in cash per quarter going forward. But with the cash they raise, they emphasize they're well-positioned and have the runway needed to execute this whole strategy.
Okay, it all sounds very ambitious, very forward-looking. But pivots like this are hard. What did they say about the timing? When does this AI revenue really start to kick in? And what are the risks?
Good questions. On timing, management was pretty clear that the next quarter or two will likely be softer on the revenue line as they navigate this shift.
So manage expectations near term.
Exactly. The bigger ramp from AI data centers, they're pointing towards late 2026 for that to really start contributing meaningfully. And the 800-volt specific stuff is more of a 2027 story.
Late 2026, 2027.
Okay.
And long-term margins.
They reiterated their target of getting non-GAAP gross margins over 50% eventually. The idea is that these AI and energy infrastructure markets command higher value, plus they get the cost benefits from that Powerchip 8-inch line kicking in.
Makes sense. What about that NVIDIA partnership? Has that opened doors with other big data center players yet?
It sounds like it definitely has boosted engagement. They said the NVIDIA announcement has led to more conversations with other potential data center customers.
But maybe too early for widespread adoption calls.
Yeah, seems so. Especially on the 48-volt side specifically. Navitas feels they have the resources needed, and while NVIDIA is obviously a huge influencer, other big players are also pushing towards higher voltages independently. It's becoming a broader trend.
Okay, so putting this all in context, Navitas' story really taps into this massive macro trend, right?
Yeah.
The desperate need for better power semis like GaN and CLOS.
Absolutely. It's driven by AI's crazy power thirst and, the whole EV transition. You look at the broader semiconductor index, the SOXX, it's been strong lately, up maybe 30% in 3 months, though flat year over year. But investor focus is definitely shifting within semis.
And Navitas seems to be aiming right for those high-growth, high-margin spots within that shift.
That's the strategy. And like we talked about, that positive market reaction to the results, despite the GAAP miss, kind of confirms it. Investors seem willing to look past near-term bumps if the long-term story is compelling and targets these critical emerging markets.
Plus the capital light model helps.
Right. And you saw the stock run up quite a bit before the call, right? News about the capital raise, the NVIDIA deal, the Powerchip foundry agreement. The market was already starting to price in some of this transformation.
Even with some insider selling noted.
Yeah, there was some director selling, but the overall tone from management post-call was, cautiously optimistic. On the street, it's a bit more mixed, but leaning promising. You had Rosenblatt reiterating a buy focused on that AI pipeline.
But not everyone's convinced.
No. Morgan Stanley, for instance, kept an underweight rating. They acknowledged the tech edge, but cited execution risk. So you definitely have differing views out there.
So the narrative is clear. Niche mobile player trying to become a key enabler for AI and EVs. That huge stock run-up, nearly 300% in 3 months, suggests the market's buying into the story, at least partly.
It definitely suggests that. Now the focus shifts to execution. Key things to watch will be that first silicon from Powerchip later this year, Q4. Then seeing initial revenue from the NVIDIA reference design, hopefully in the first half of 2026.
And on the EV side.
Sampling their discrete Silicon to auto OEMs, that's expected next summer. And of course, any change in the China tariff situation could impact things. They also have an analyst day coming up in November, which will be important.
Lots of milestones to track. Okay, let's shift gears. It's time for our This Is Not Financial Advice segment. Let's imagine we're pitching Navitas to an investment committee. Give us an outrageous but plausible trade idea.
All right, remember everyone, this is purely hypothetical for informational and entertainment purposes only, not actual investment advice.
Definitely not. Okay, the pitch. Navitas is a transition story. Consumer electronics to mission-critical AI EV infrastructure. Volatile? Sure. High reward potential? Absolutely.
Okay, trade idea one. The AI future is now long play. This is straightforward. You take a long position thinking multi-year. You're betting that Navitas nails the Powerchip ramp-up, starts generating real revenue from that NVIDIA HVDC work, and becomes a key player in 800-volt data centers by 2027.
And the outrageous but plausible part.
The outrageous part is arguing the market still doesn't fully grasp how big the AI power problem is and how valuable Navitas' position could be as one of maybe only 2 suppliers at the full Gantic toolkit. The risk is clear. Near-term revenue weakness, execution stumbles. But if they hit those milestones, the upside could be significant.
Okay, I like it. What's idea number 2 for maybe a different risk profile?
Idea 2. The short-term volatility, long-term opportunity options strategy. This one's for those maybe more comfortable with higher risk, using options. Think about buying long-dated call options, maybe 6 months, maybe 12 months out.
Targeting straight prices that assume some success.
Exactly. Strike prices that reflect potential upside if that NVIDIA revenue starts showing up or the Powerchip ramp looks solid. The outrageous part here is you're explicitly accepting the near-term revenue dips and the stock's recent run-up, but you're betting on the timing of those future catalysts.
So you think the market will start pricing in that 2027 potential much sooner, maybe as early production ramps confirm late next year?
That's the bet. You're positioning for the big structural shift, acknowledging the bumps along the way from winding down the mobile side. It's about capturing that potential inflection point.
2 interesting and definitely plausible scenarios there. Okay, wrapping up this deep dive on Navitas Semiconductor, it's really a fascinating case study of a company making a bold, conscious choice to reshape its future.
Yeah, shedding parts of the business to go all in on the huge growth expected from AI data centers and electrification. It's aggressive. The potential market is enormous, but like we've said, execution is absolutely everything now.
They're betting the farm on GaN and CTES, solving the AI era's power crisis. And the market, at least initially, seems to be giving them some credit for that bold move.
It does. The confidence seems to be there, at least partially priced in.
So here's the final thought for you to chew on. We heard about AI power use potentially jumping tenfold by 2030, becoming a real global energy issue. Forget just semiconductors for a second. What other industries might get completely turned upside down by this fundamental need for hyper-efficient power? Where else could we see these kinds of dramatic strategic pivots happening?
That's a great question to ponder. And just a final reminder, everything we've discussed today is for informational and entertainment purposes only. It is definitely not financial advice. Please do your own research and make your own investment decisions.
Absolutely. We always love hearing what you think. What caught your attention in this Navitas story? Let us know. Until next time, keep digging for those insights.